Hi, I'm Tomer Dick Jarrell with Crossfield Strategic Partners. Today, I want to walk through an educational comparison that comes up frequently in conversations with clients. How indexed universal life insurance, IUL, differs from a qualified retirement plan like a 401k, and why some individuals choose to use both as part of a broader financial strategy. I want to be clear upfront. This is not a recommendation to replace your 401k with an IUL. These are different tools that serve different purposes. The goal here is to help you understand the distinctions so you can have a more informed conversation with your tax and financial advisors. Let's start with the basics. A 401k is a qualified retirement plan offered by many employers. Contributions are made pre-tax, investments grow tax deferred, and withdrawals in retirement are taxed as ordinary income. Many employers offer matching contributions, which is a meaningful benefit. Annual contribution limits apply, and there are rules around when and how you can access the money, including required minimum distributions beginning at age 73. An indexed universal life insurance policy is a permanent life insurance contract with a cash value component. The policy provides a death benefit, and the cash value earns interest linked to a market index, such as the S&P 500, subject to a cap and a floor. The floor means that in years when the index declines, the credited interest may be zero rather than negative, though it's important to understand that policy charges and fees still apply and can reduce cash value even in flat or floor years. IUL is not a securities product and does not directly participate in the market. Cash value projections in any illustration are non-guaranteed and based on current assumptions. Actual results will vary. Here are some of the structural differences clients often ask about. On contributions, 401k plans have annual IRS contribution limits. IUL policies have premium flexibility, though overfunding beyond certain limits can trigger MEC status and change the tax treatment. Consult your tax advisor. On access, 401k withdrawals before age 59.5 typically trigger taxes and a 10% penalty. Policy loans and withdrawals from an IUL may be available on a tax-advantaged basis depending on how the policy is structured. Your tax advisor can confirm the treatment for your situation. On required distributions, 401k plans require minimum distributions beginning at age 73. IUL policies do not have a required distribution age, though policy loans reduce the death benefit and cash value and must be managed carefully to avoid lapse. The following is a hypothetical illustration. All names and details are fictional and do not represent any actual client or outcomes. Consider Emily, a 40-year-old professional exploring how to diversify her retirement income sources. Rather than viewing IUL as a replacement for her 401k, she worked with her financial and tax advisors to evaluate whether adding an IUL could complement her existing plan, giving her an additional source of potential cash value access in retirement that her advisors could help manage alongside her other assets. Whether that structure made sense depended entirely on her specific tax situation, income, health profile, and long-term goals. That conversation started with her advisors, not with a single financial product. If you're curious about how IUL fits or doesn't fit into your retirement strategy, that's a conversation worth having with your financial and tax advisors. I'm happy to walk through how the mechanics work and provide an illustration so you can evaluate the numbers with your team.